I say the word investing to you, what comes to mind? Maybe you have an image of Warren Buffett in your head, or other famous investors that you've heard of. Maybe you see Scrooge McDuck swimming in his gold coins, dollar bills flashing before your eyes. Maybe you see a casino. You think about the roulette wheel. You think about putting it all on red. Or maybe you think about somebody you've seen on YouTube or Instagram who's talking about rising and grinding, about getting that daily bread, about got to go out there and outwork everybody. Let's change all that. Let's wipe the slate clean. Instead, let's think about the mindset we need to be a successful investor. Investing doesn't have to be complicated. It can be challenging, but to solve those challenges, we just have to have the right mindset in place to have us thinking for the long term and setting ourselves up to have every chance of success. The first thing we'll talk about is that very thing, the long term. Rome wasn't built in a day. Getting rich overnight is a sucker's pitch. This takes time. Investing takes time and patience. When people talk to me about the market, I'll tell them, don't invest money you will need for the next 3 to 5 years. That's to protect you because anything bad can happen in 3 to 5 years, and you want to give yourself an adequate time frame for the normal, for the average to work out. But to really make money, you need to be thinking even longer term, more than 5 years, more than a decade. It's a long-term marathon. That doesn't mean you need to predict the future. You don't need to see that far ahead. You just need to be prepared to be thinking about results over longer time frames to have real success. Why are you here? I don't mean existentially. Why are you here watching a video about investing? Presumably you want to succeed in investing. You want to do something good with your investing. And part of that is setting the right goals. The most basic goal to investing is to protect your money, which generally means to grow your money at a faster rate than the rate of inflation. As long as you do that, the money you put in will have the same or more purchasing power when you take it out years later. That's a minimal goal. The other more obvious goal is you just want to grow your money. But both of those are abstract. I'd like instead for you to be thinking about tangible goals, reasons that you're trying to get your money to work for you to help you succeed in your life. They can be things like paying for your children's college. They can be growing your money to make a down payment. They can be, I want to travel with luxury in my retirement. Whatever it is, something real that you can sink your teeth in so that as you ride through the market over years, it's not just a thing of numbers on a screen. It's not something abstract. It's not a casino game. It's something you're working at so that you can achieve those goals over time. Goals are great, but if they're not realistic, they're not going to be helpful either. You can set a goal of doubling your money in 5 years. That's a tough goal to achieve. It's possible, but tough. You set one that's even more ambitious, you're really going to have a hard time. So let's figure out what realistic expectations are. I'm going to anchor everything on the S&P 500 and the indexing strategy, which is the average that everything else centers on in the stock market. Over the last century, the S&P 500 has returned about 10.3% a year is the number I have. That's once you reinvest dividends, which we'll talk about in a later point. All of these numbers are 10.3%. Let's start with that as a number. Let's then go to the beginning of 2000. If we invested from that point through to the end of 2022, we'd be receiving 6.5% on an annual basis. That's a lower number. It's not a great number. But that's a pretty decent range to start thinking about. Starting in 2000 was starting at the peak of the dot-com rally and bubble. So it was a really terrible time to start investing, and you still made 6.5% a year. If you started in 2003 instead of 2000 and just went 2 decades, that number gets up to 9 to 10%. So again, you kind of have that range. I would suggest as a conservative number to kind of put on as your expectation, as the center of your expectation, something like 8%. 8% is less than the 10% I just talked about, but it gives you a little bit of margin of error in case you are investing at the wrong time in the market We're not going to worry about time in the market, but 8% is a good general center point to think about for your expectations. It's not a promise. Anything can happen. I'm just trying to give you sort of the time frame and the mindset to think about as you think about investing over the long term. Just to let you know, the best decade in the last century for this S&P 500, the 90s returned 20.7% per year. And the worst decade was 1972 to 1981. The market returned about 5.7%, trailing inflation, so missing our most fundamental goal. So that's, again, sort of a bounds to think about, but 8% is where I think you'll be able to give yourself some reasonable focus. What does 8% translate to? There's a nice little rule called the rule of 72, where if you divide 72 by the number that you're getting as your percentage return every year, you'll see how long it takes to double your money. With 8% returns, you double your money in 9 years. We're planning to add to our money over time when we invest, not just put a fixed number at the beginning. But if you did just put a fixed number at the beginning, earned 8% over that time, it would take 9 years to double it. So that's a way to think about things. Why can we have those expectations? What's going on here? How does this all work? I want to go over some of the basics of investing. We won't get to the level of Adam Smith. We won't be talking about the Amsterdam Stock Exchange, but I want to give us a little bit of a foundation so that when we are investing, we at least have a concept of what's going on. To do that, I'm going to use two cliches, one of which I've already used. Put your money to work for you. What does that mean? What's happening in the stock market and in capitalism in general is that people who have money are getting it to people who can use that money to build a product or a service that will then deliver value to somebody else. That's the idea. So, for example, let's say I have an idea for headphones. I want to make headphones. I don't have the money to buy the factory, build the factory, hire employees, design it, sell it, market it, and so on. So I go to investors and say, hey, I've got this idea. I think it'll return this amount of money over time. Here's my plan. And they give me that money if they believe in my idea. I put that money to work by building the factory, doing all the things that go into running a business. I then sell those headphones to people who want my headphones, who are willing to pay me a little bit more than it cost me to make the headphones. And I take that money and I put it back into the business to grow the business further. Or at some point, I return the extra money to shareholders. This is after I've taken my own pay. This is after I've paid all my employees and so on. That's the idea. That's what capitalism is at its base. It's very simplified, of course, and there's certainly problems with capitalism, but that's the idea. Then, if I later have a plan to sell microphones, I can go back to the investors, show my track record, and they can decide whether to invest or not. That's not what's literally happening on the stock market. Most of the time, we're not giving money directly to the headphone maker or to Apple or to Amazon or to Walmart or whoever. Instead, we're trading on the secondary market. But what we're doing is we're setting the average price so that when it comes time for any of those companies to raise money, they have a share price that should correlate with their prospects. And it's going to vary, and we'll go into those details a lot later. But then they can raise money so that they can then grow their business. It's meant to be the most efficient way to allocate capital. It doesn't always work, and there's certainly more ethical problems that people will raise beyond just the fact that it's not always efficient. There are people trying to game the system, but that's what's happening. So when you put your money to work for you, you're getting the benefit of the growth of these different companies that you're investing in because they're putting the money that they've raised to work for their shareholders. The other cliche, the stock market is not the economy. You might have heard that one in a political context. It usually comes up when people want to point to the Dow Jones or the S&P 500 as this sign of how the country is doing. And it's not really what that's telling you. What's happening when the index rises or falls? On any given day, you don't know. But over the long term, it tracks corporate profits. How much money are corporations that trade on the market making? Or how much does the broader market expect those corporations to make in the years ahead or months ahead even? That's what's happening on the stock market. So it represents a chunk of the economy. Corporate profits do correlate with other things, but they are somewhat independent of the economy as a whole. They are a part of it, but not the whole thing. So there's a distinction. Some people may be squeamish hearing about capitalism, hearing about corporations, corporate profits, all of this stuff. I'm empathetic to that. I have built a career in finance, so I've kind of cast my vote in that sense, but I don't think that capitalism is an unadulterated good. It definitely has its problems. That said, I don't think the system is changing anytime soon. So for those of you who don't want to participate in the system, you're ultimately only going to be depriving yourself. It's also worth noting you're not literally giving your money to companies most of the time. You're holding them, you're benefiting from profits, but you're not actually contributing to their business. Now, we'll talk about investing in your values at some point, and it's something that you can definitely do, and I do to a degree with my investing. But I just think this is your best opportunity, the easiest opportunity for you to grow your money over time to benefit your future, and not participating will only deprive yourself. However you choose to invest, the key to success is having the right mindset. That means looking out to the long term, setting goals, having realistic expectations, and understanding what's going on and why this all works. If you decide to invest actively, you need to understand more than that. But as a baseline, this is going to correlate and translate to every style of investing. You need to have these basics. What do you do once you have that mindset in order? My next video is going to talk about the way to index, which is the first path to investing and the one that makes sense for most investors. It's already available on the channel, so you can check it out. Subscribe to A Short Investing Guide to get more of these videos. We're going to be rolling them out throughout the summer and beyond. Check out shortinvestingguide.com for more materials. Thank you for watching. Keep that mindset sharp, and see you next time.